Hi, my name's Dominique. I'm an associate in our financial services team here at Fox Williams. Today we will be discussing the regulatory landscape of lending in the UK, covering two types of regulated lending: credit agreements and mortgages. Let's explore the key aspects and considerations. It is an offence to carry on regulated activity in the UK without FCA authorisation, unless you are exempt from the obligation to be FCA authorised. It is therefore essential to understand when specific lending scenarios will be considered regulated activities under the Regulated Activities Order, and whether any applicable exemptions may apply. So what is credit? Credit is defined under the CCA as a cash loan and any other form of financial accommodation. This isn't overly instructive, so we look to case law to better inform the definition. The most commonly accepted approach is to apply a working definition that credit is likely to be provided where there is a contractual right to defer payment of a debt or sum of money that is otherwise due immediately. This still is quite broad. The most typical form of credit agreements we see are products such as personal loans, credit cards, hire purchase agreements, which are widely used in the motor finance industry. If you are proposing to provide any of these products to individuals, then your product is likely regulated. There are exemptions in place in certain circumstances. For example, if the lending is for business purposes and the credit provided is over £25,000, this will fall outside the regulatory framework. There are similar exceptions available for low-cost loans and loans made to employees. If an agreement is a regulated credit agreement, there are many regulatory touchpoints that will need to be considered. For example, there are strict pre-contractual disclosure requirements as to the form and content of the credit agreement itself, and the obligation to provide ongoing servicing documents, again, which are prescribed in form and content. A lender must also make a reasonable assessment of the customer's creditworthiness and how affordable and sustainable the credit is for the customer. Failure to comply with these requirements may result in the contract being unenforceable without a court order, a restriction being imposed on the lender's ability to charge any interest, or FCA enforcement. So moving on to mortgages. The second type of regulated lending is mortgages. Mortgages are, by their very nature, different from credit agreements because they're secured on land. A residential mortgage will be deemed a regulated mortgage if it meets three conditions. 1, the borrower is an individual or a trustee. 2, the credit is secured on land in the UK. 3, at least 40% of the land is used or intended to be used as or in connection with a dwelling by the borrower or a relative of theirs. There are certain exemptions in place. For example, if you are seeking to offer a mortgage to a high net worth individual, which is an individual that meets certain income and asset thresholds, or if you're offering the mortgage on a buy-to-let basis. Similar to credit agreements, certain disclosures must be provided to the customer before entering into a mortgage, which are very prescribed in form and content. A creditworthiness assessment must also be undertaken before entering into the mortgage. Failure to comply with requirements is a breach of the FCA handbook and may result in FCA enforcement action. Legal considerations aside, keeping out an eye for general upcoming regulatory changes is essential. Any lending activities will need to consider customer due diligence, ensuring clear and transparent communications, adherence to financial promotions restrictions, and compliance with GDPR. Overarching this, it is important that consumer duty is considered and applied appropriately. In conclusion, understanding the nuances of the regulatory framework is vital. The determining factors whether the lending falls under the Consumer Credit Act or qualifies as a regulated mortgage contract include the type and purpose of the credit, the amount, the nature of the borrower, and the security against which the credit is offered. However, if in doubt, it's best to seek advice on the scope of your activities to ensure you're acting in compliance with the regulatory framework.